Good afternoon, everybody. Thank you for joining us today. We will be getting started now. Just want to welcome everybody and joining us for our presentation today on impact of due diligence on valuation. If you're looking to purchase or sell a business, then it's important to understand the value of the business and that the financials are accurately representative. Alec and Mark today will walk us through some key considerations and examples from projects that they've worked on in the past to be able to help you. They review some key formulas and good questions to ask during the evaluation process. We'll save time at the end for questions. I'm Carolyn Powell. I am your host today, and I am the Development Director at Tronconi Seguera & Associates. Just a couple things to get us started today. On the right-hand side of your screen is a toolbar. In there, you can grab some handouts. Our Meet the Experts is in there, and also a copy of today's presentation. There is also the question section. If you have any questions throughout the presentation, just put them in there. We'll try to get them answered throughout the presentation. And if we don't, definitely by the end, we will answer those questions for you. Also today, after the presentation, you will receive a survey. Just let us know how the presentation was. If you'd like a follow-up meeting or call with Mark or Al, and give us any feedback or other topics you would be interested in hearing about. So without further ado, let's get started. Tronconi Seguera & Associates is a consulting firm. Mark Ferm is a CPA and partner here with over 25 years in public accounting. He has a broad range of industry experience. He's helped multinational and domestic companies in the areas of mergers and acquisitions and financial reporting. Al Marotto is a CPA and ABB, which is an accredited business valuation professional. With over 14 years in public accounting, he served industries of manufacturing, contractors, non-for-profit organizations, labor unions, employee benefit plans, and governmental entities. So I'm going to hand it over to Al to get us started today.
Thanks, Carolyn. So my goal today is to illustrate some of the shortcomings that I see with the rules of thumb use to value a business, which are commonly used as shortcuts really to determine value. They're often kind of used inappropriately or can result in miscalculations, understatements, or overstatements of value. But in order to get you to that point, I'm going to get a little technical. I'm going to walk you through some various valuation techniques that I use when I perform my evaluations, so you can kind of see where those shortcomings are once you get an understanding of the valuation techniques that I use. Then I'll transition to Mark, where he'll talk about due diligence and some of the things he looks at when he's doing the due diligence portion of the transaction services that we provide. Some of the things he looks at are very similar to the things that I look at when looking at cash flows and EBITDA and things like that. So I'll hop into some of his presentation when he's discussing those things. And then we'll wind it down. But just to kick it off, firstly, there's three primary valuation approaches that we often utilize. There's the asset approach, the market approach, and the income approach. I'm not going to spend much time on the asset approach. That's why the market approach and income approach are in bold there. Asset approach, I generally use as a baseline value for my business valuations. You're looking at the balance sheet. You're looking at the assets first. If they require any adjustment, you're looking at liabilities. You remove the liabilities from the assets. The result is the net book value. And that's generally the value of your business. That's most commonly used in a liquidating basis evaluation, meaning the business is probably going out of business, is no longer a going concern. So not often used, but not the point of this presentation, so I'm not going to get into too many details related to that. But that's really all you need to know, that there is that other approach, the asset approach. Market approach, I like to draw the comparison to home ownership or buying and selling a home, because I think that's the most relatable experience that people have. When you go to buy a home, your real estate agent will often give you market comps. So if you're looking at a 1,800 square foot house with 3 bedrooms and 1.5 baths, in the same neighborhood that you're looking in. He'll give you an approximate value of the houses that have sold in that area, so you can kind of base the value or your offer for the house you're looking to buy on those market comps. So that's a similar thing that we do when we look at appraising businesses. Is we'll look at transactions that are housed in the transaction database in the same industry that our business is in, and then we'll compare the multiples of those transactions to see if there's any sort of correlation to revenue or to earnings, and then see if we can apply that to our business that we're valuing. So that's one method on the market approach. There's also the public company guideline approach, where we look at public company comps. We don't often use that because public companies are so large, and we're looking at these smaller local businesses or just smaller businesses in general that the average market comp of a publicly traded company is much larger than a small company we're looking at. So not always appropriate. And then finally, the income approach that I'll talk about in a little bit more detail in the next couple of slides. So I'll save that for the next couple of days here going forward. Just to reiterate rules of thumb, or kind of give you a background on rules of thumb. So those would technically fall under our market approach, that second approach I talked about. Sometimes called the industry method because these rules of thumb are derived from transactions of companies in that specific industry. The basic formula that I want you to remember in bold is financial measurable times rule of thumb equals value. So remember that for the next couple of slides. We'll circle back to that, but commonly a rule of thumb is applying a multiple, which is your rule of thumb, to a financial measurable to equal the value of your business. So commonly used rules of thumb that you'll most often see are a multiple of revenue. One of those that we commonly see for accounting firms, professional practices, an accounting firm is a lot of times 1 or 1.5 annual revenue is the value that people will ascribe to an accounting practice using a rule of thumb. There's a multiple of EBIT or EBITDA. I said EBITDA a little bit earlier. EBIT or EBITDA is earnings before interest and taxes, and then EBITDA is, of course, earnings before interest, taxes, depreciation, and amortization. So sometimes you'll see a 3 times multiple of EBITDA, 4 times multiple of EBITDA, 5 times multiple of EBITDA. And then finally, another common rule of thumb is seller's discretionary earnings. Similar to EBITDA, it's just kind of taking it one step further. We're going to get to an EBITDA point, and then we're going to add maybe the owner's comp to that, or we're going to add some non-discretionary or non-recurring items back into our EBITDA measure of financial measurable to get to the value. So where do these rules of thumb come from? Like I said, it's looking at a number of transactions in the industry. I kind of see it as sometimes a self-fulfilling prophecy, though, because if you continue to use a rule of thumb over and over and over again, that rule of thumb becomes more commonly used and therefore perpetuates the use of that rule of thumb. And then now you've had an established rule of thumb for value that has been maybe used inappropriately, but is now the barometer of value for a specific industry. Sources that I look at are Business Reference Guide mostly, but you can use industry resources. Business brokers have different rules of thumb. For auto dealerships, there's a buy-sell advisor called Hague Partners. They publish a quarterly update on multiples that they're seeing. So a lot of auto dealers will use that Hague report to kind of get a gauge of what their dealership may be worth. So that's generally a rule of thumb and how it's used. Pretty simple. Like I said, financial measurable times rule of thumb equals value. Remember that for the next couple slides.
Yeah, I was gonna say, if I could just jump in now for a second. I think one of the more dangerous rules of thumb that I see being used is actually multiple revenue. And it's, because not every revenue is created equal, right? Not every dollar revenue is the same profit. You can find significant variations in the profitability of one organization's revenue versus another. So I think I find it to be one of the more dangerous sort of rules of thumb. I don't know if you have a consistent.
No, for sure. I'm going to kind of get into that in a little bit. I guess I can do it right now, though. But the common expression is revenue is vanity, profit is sanity, and cash is king. So if you're starting at that revenue figure, it doesn't necessarily mean that you're going to receive a significant benefit as the owner because of how well you're using your assets, how well you're utilizing your staff, and how profitable you are. At the end of the day, I want to know what cash returns I'm going to get as an investor, not necessarily the revenue I'm generating. And you'll see that too in issues with rules of thumb. So if you're using a 1 or 1.5 times revenue multiple for an accounting firm, let's say, versus a 2.5 multiple for EBITDA, well, looking at an RMA industry average for profitability for a $10 million accounting firm, it's about a 19% bottom line. So if I have a 19% bottom line on average on a $10 million revenue generating company, the EBITDA multiple is 2.2, I believe, versus a 1 to 1.5 times revenue. So we're looking at a $10 million valuation using a revenue multiple of 1 versus a $4.2 million valuation using a 19% average, EBITDA.
Yeah, another great example that we've run across before is with a travel agency. This particular travel agency that we were involved with was including in their revenue number all of the airfare tickets for airlines and things that they're pretty much just an agent. So they were valuing inappropriately so based on sort of a gross number. They're obviously not flying the planes and really running the hotels. They're really just getting a commission off of those tickets. And so they thought they were worth significantly more than they really were, because when we really look at the cash flow, it was more on a net basis. So that rule of thumb really, I think, kind of really threw them a little bit.
All right, so I'm going to hop a little bit more into the technical aspects of this, and I promise we'll get back to more general discussion, but I think it's important to kind of get an idea of this, and then I can kind of tie it all together here. But basically, the income approach is an approach that we use a lot when we do our valuations. It's really based on a theory that the value of a business is the sum of the present value of all the future benefits that are expected to be received from that investment. I know that's a lot of words, but if you see that first formula there, present value equals earnings or benefit stream over 1 plus K, which is your discount rate. So we're just basically discounting our future earnings that we're expecting to receive annually over a specific discount rate. We add them up, that's our value. The capitalized economic income method is another approach that's similar to the discount economic income method. It's just really a simplified version of it. If you were to iterate this calculation, the first one, the discounted cash flow method, at a stable growth rate, you could do the same thing using the formula below by subtracting the growth rate from the discount rate. So if you had $100 at E1, then $103 at E2, and $106 at E3, we have a 3% constant growth rate. Rather than calculate that entire value at the top using that formula, we can simply do $100 over 20% minus 3% growth rate, standard growth rate, be 100 over 17% and give you the same result. So why are there differences? Why would we use a different method over the other method? Well, it depends on the life cycle of your business and depends on the circumstances of your business that aren't necessarily considered in the rule of thumb either. So with the discounted cash flow method, we're basically saying earnings aren't stable. We don't see our future short-term earnings as being stable. There may be a significant growth pattern. We may be a startup company. You've heard probably of a hockey stick level of growth, where you have the blade of the stick is somewhat flat, and then all of a sudden we have this exponential growth once we get to the shaft of the stick, because we're in a startup phase, and then all of a sudden we become extremely profitable. Well, a capitalized economic income method would undervalue that business because we're not considering all this growth in that shaft of the hockey stick using a capitalized economic income approach. You also might use a discounted cash flow method too. A good recent example is just the impact of COVID on businesses. So, in 2020, a lot of businesses were hurt by, the few months of shutdown. They've never recovered, or they may have been hurt for a month and a half or 2 months, like some auto dealers, and then all of a sudden they had record profitability by the end of the year because there was inventory supply constraints, interest rates were low, so more people were going to buy cars. Their floor plan financing was cheap now because interest rates were low, so that increased their profitability. You had stimulus money coming in, so people were more willing to spend on cars. And then with the supply being short too, you had more demand for used cars. So now used cars values are going up, increasing profitability too. So it wouldn't really be accurate to use the capitalized economic income method based on that scenario, considering kind of the short-term nature and impact of what was going on macroeconomically and how it was impacting the business. All right, so I'm going to take you back to middle school math here quickly and kind of show you how this is interrelated to the rule of thumb approach, as I promised. So as I previously mentioned, capitalized economic income method is your adjusted economic income, let's say cash flow for this situation over a capitalization rate equals my value. So we can restate that formula as adjusted economic income times 1 over my capitalization rate equals value. As I said before, and I told you to remember that bolded formula, financial measurable times rule of thumb equals value from the rule of thumb slide. So therefore, we can say that 1 over capitalization rate equals multiple. So essentially, a rule of thumb is really my capitalization rate, or the inverse of my multiple is my capitalization rate. So if we go to the next slide, I'll kind of show you what goes into developing a capitalization rate. So capitalization rate, as I mentioned before, is a discount rate minus growth rate. Growth rate, we're looking at something that's long-term and sustainable. So something that we're going to achieve over the long run, not something that, next year I think I'm going to have 10% growth. The year after that, I'm going to have 12% growth. We're talking about long-term sustainable growth that the company's expected to achieve, into perpetuity. Generally, it's around 3 to 6%. We're talking about bottom line growth. We're talking about cash flow growth. We're not talking about revenue growth. We're talking about bottom line growth for the most part. 3 to 6 is generally what we use, just because if you're anything over 6%, or even I would say even over 5.5%, like 6% is pretty high. Technically or mathematically, you would outpace the growth of the U.S. economy, because the U.S. economy's GDP isn't growing at even that rate on an annual basis over its long term. So if you were to calculate the value of a business and sustain 6% growth over the life of that business or into perpetuity, we would eventually outpace the U.S. economy, which is not realistic. So what are some things that I consider when I try and develop a growth rate or think about a growth rate? Well, I consider the industry my business is in. What macroeconomic factors are affecting growth? I mentioned auto dealers, interest rates play a big role in profitability and the growth of my bottom line. If interest rates are rising, my profitability is going to continue to increase going forward. I consider the industries that my business is serving. So the metal stamper, who's primarily serving the railroad industry, has a much different growth prospect than the metal stamper who's serving the Department of Defense. I consider the location of the population of an area, so socioeconomic factors. So the home builder in Buffalo has a lot different growth prospect than the home builder in Houston. And I consider the ability to grow. Management or the owners may be telling me, we're on pace for 10% growth next year and 15% growth next year, and we're doing gangbusters, and I just see this thing continuing to grow. Well, I take a site tour, when I'm having that management interview, and I take a look at its manufacturing, shop floor, and I ask them, well, how many shifts are you running? Well, we're at 2.5, 3 shifts, 2 shifts right now. We're about to go to 3 shifts. I say, okay, and then I look and I see all the machines are at full capacity, and I see that there's no more space in the manufacturing warehouse. So, you may be on that, you may have been on that path of growth in the recent history, but your future outlook of growth is not really realistic, considering, your shop floor and your personnel are already at max capacity. So, even if you were to have customer orders coming in, is it realistic that you can fulfill those? Is that growth, realistic? So you have to consider that as well.
Yeah, I think one of the things I just want to highlight there, Al brings up a good example of, and we have some case studies that I'm going to share with the group and some of the experiences we've had. And going on site, Al just sort of went through that example of going on site, observing capacity. And that's important to go on site, because if you hadn't gone on site, you might not be able to really note that. You might assume that their projections and valuing the business were actually as rosy as they thought it was. But if you know that you're out of capacity, that growth pattern isn't going to be able to be sustainable.
Okay, so that's the one half the component of the capitalization rate. The other half component is the discount rate. The discount rate is simply my required rate of return, or my risk of achieving my expected future benefits from my investment. So higher the risk, the less I'm willing to pay for my investment, because I perceive a higher risk in actually getting a return on my investment. So by lowering the amount I'm willing to invest and lowering the value, I would generate a higher rate of return than I would require to invest. So, as an example, let's say a company is generating $100,000 annually. If I'm willing to invest $500,000 for that $100,000 annually, that means I have a 20% discount rate or required rate of return. But let's say I'm only willing to pay $400,000 for that same $100,000 because I think that the perceived risk is higher. Well, that's a return of 25%. So you can see how that risk rate goes up, or that required rate of return goes up as my value comes down. It's kind of pulling the different levers because I really have no control over that $100,000 I'm expecting to receive. I can only control how much I want to invest. And that's kind of like the basics of valuation really is. I'll offer you less for a higher rate of return based on my risk profile that I see in your business. So what are the components of the discount rate that we use, and how do we come up with our own discount rates? We use a build-up method, it's called. You'll see them bulleted there, the different components. First one is risk-free rate. Simply put, I can get 4% from an investment in a treasury bill. It's backed by the government. It's essentially risk-free. So at minimum, a business needs to give me 4% return before I even consider investing them, giving them $1 of my money when I can go get a substitute investment. Equity risk premium, small stock risk premium, are premiums on that risk-free rate. So an equity risk premium is the rate of return from 1926 to 2022, above and beyond risk-free rates that have been generated by investments in an index fund of large cap stocks on New York Stock Exchange. Small stock risk premium is similar to that, except it's really specific to small stocks. Those have generated a 4% premium. So 4%, 6%, 4%. At minimum, I need about a 14 to 50% return on investment from your privately held business before I even consider investing in it, because I have all these substitutes available to me that have a much, not much, but a different or less risk profile than a privately held business. Why does a privately held business have a higher risk profile? Well, we get down to company-specific risk and the company-specific risk premium. I may add a risk premium to that 14, 15% base risk because of certain things that your business has that these publicly traded companies don't, or even companies in your same industry, you may be outperforming or underperforming. So, do you have a customer concentration? Do you generate 25% of your sales from one customer, or do you generate 25% of your sales from 15? Your risk is obviously much higher if you're only generating sales from one or two key customers. How old is your management team? How reliant are you on that management team? How involved are they in customer relationships? If that management team member leaves, what's the impact to my future revenue, my future income stream, my future cash flow if I don't have that key personnel there anymore? We think about access to labor, cost of raw materials and sensitivity to raw material prices. So there's a number of different things you have to consider. I'm not going to belabor the point anymore and continue to go over all the different things to consider, but there are a number of different considerations for company-specific risk premium.
Yeah, I think the theme of today being valuation, and some of the commentary that I'll have a little bit later, the diligence really kind of covers that company-specific risk. Right, so the more items that you find or issues that you find in diligence, the higher that company's specific risk premium is, the higher the discount rate is, and there's an inverse relationship to that. So, and it kind of makes common sense, right? Even sans the formulas, the higher the risk is, likely the valuation may go down because of the increased risk. And the only other comment I'll make on that is that with the risk-free interest rate, with rising interest rate environment that we're experiencing right now, again, you're seeing sort of a cool down in the transaction market because those risk premiums are going up, and in theory, the valuation of businesses are going down. So if I'm a business owner, I may wait until the recession fears and the interest rate environment kind of settles back down a bit, because that might have a positive impact on the valuation on sale.
Right. So I'm going to try and land the plane here and wrap everything up and kind of wrap up all these technical things that I discussed into more of a coherent summary here for you. So essentially, rules of thumb are a simplified version of the income approach that we use when we do our valuations. And the whole point of what I was trying to outline or illustrate is there's a ton of different things that you need to consider about the specific company that you're valuing when you are developing the discount rate, the growth rate. Am I going to use cash flows? Am I going to use EBITDA? Am I going to use a discounted cash flow method? Am I going to use a capitalized economic income method? What method am I going to use? So I think that's the biggest issue with rules of thumb, is that it doesn't really consider all of those other factors that you should be considering when preparing a proper valuation of a business. That a rule of thumb simply just doesn't hit. The one thing I will say though is having this knowledge now and knowing that you can use a rule of thumb, just know that you should be, or you'll know how to maybe amend that rule of thumb based on the risk profile of the business that you are looking to buy, or based on your business that you're trying to sell. Maybe someone's saying, well, the EBITDA multiple is 4x. Well, I should command a higher multiple because my risk profile is probably lower than a lot of my industry peers, industry competitors, based on like my knowledge of my own business and my knowledge of my competitors. So I wouldn't say that rules of thumb are totally useless. I do like to use them as a sanity check, like I said, in conjunction with my income approach and knowing what I know about the business and getting to know what I know about the business and doing all that related research. So they are a good sanity check. They're easy to understand. 2 times EBITDA, 100% of revenue. Like that's pretty simple. It's a pretty simple formula. I mean, I spent one slide on the topic, so they're easy to understand. And like I said, I'm not going to belabor the limitations. The biggest thing is they just ignore the economic realities of the business. Like Mark said earlier, using a revenue multiple, what's the point of that if my bottom line is minuscule? I'm overvaluing a business by looking at revenue. It's ignoring the economic reality of the situation. A lot of times we'll value small businesses maybe using that revenue multiple because small businesses, the owner tends to run everything through their business, and it's a little bit easier to just use the revenue as my gauge rather than try and fix the bottom line, adjust the bottom line based on all these personal expenses or all these non-recurring expenses or items that are run through that income statement. So sometimes that revenue multiple is useful, but sometimes the business just isn't that profitable, and so now we're applying the multiple incorrectly and we're coming up with a value that's incorrect. So that's pretty much all I had for my.
Yeah, thanks, Bill. It's very informative, and from the sounds of it, from what we've talked about so far, you might think, geez, rule of thumb, we could never use a multiple rule of thumb. And then now I'm going to carry you through the rest of our comments and say that in many instances, in some of the work, most of the work that I do with diligence and helping structure deals and valuing transactions, it gets down to multiple of EBITDA. And sometimes even stated in letter of intent. So it's like, what does that mean? You guys just told me rules of thumb aren't good to use, but we take that rule of thumb and as Alec said, we, through diligence, identify any particular issues and adjust EBITDA, if you will. We're going to show a good example, a very detailed example of how we adjust that EBITDA to make sure that it factors in what Alec mentioned, the economic realities of business. So we'll get into that in a little bit. So in terms of finding the right deal, these are some really important points in valuing a business and evaluating a business to determine whether or not it's a good deal. First and foremost, strategic fit is trying to define what your objective is in closing a transaction. What are the reasons that you want to look for an acquisition? Is it to expand geography? Is it to move into new industries, into new markets, to be able to cross-sell your product or services into that target business with their customers? So finding that strategic fit is really important. And I always say the sum of the two companies should be more than the companies individually. In other words, 1 + 1 is not equal 2, but 1 + 1 = 3. If you don't have that good strategic fit, or you do an acquisition that doesn't meet that strategy, it can be really detrimental. And I'll give an example, a case study that actually occurred with one of our clients. Culture is another big item, to finding that right culture fit, mostly because post-transaction, you don't want to be distracted by issues with culture. You're there to integrate the business once the transaction closes. You're there to work on growing the business together, not work on culture issues. So finding that right culture fit, really to avoid the distractions that could occur. And that happens more often than you think. Strength of the management team and people, that's really important to have a good, strong management team. And if you have gaps in that management team, who else do you need to hire or upgrade those positions? That could likely result in increased payroll expenses and benefits, and therefore decreased earnings, cash flow, and the valuation of the business. So that understanding through diligence the strength of the management team and its people. Customer base. So a lot of times you run across situations where there's a high concentration, especially in a lot of the markets that we serve up here, upstate New York. Small to medium-sized family-run businesses typically have a concentration of customers. And the more that concentration is there, the higher the risk. And the higher the risk, the potentially lower the valuation. Can have a big impact there. Supply chain. And Al touched on it a bit. If there's supply chain issues, there's more risk. We've all lived through it with COVID and some of the overseas restrictions in that. To the extent that you have a concentration in vendors is also another element. So considering that supply chain can also impact valuation. And consistency in earnings and cash flow. Generally, the more consistent, although high growth is really good, but that's hard to predict. It's hard to rely on projections and what that business might mean. So the more consistent we have in earnings and cash flow, and that's part of our diligence process to determine how consistent is that cash flow and how can we put faith in that to establish value for an offer. Strength of the balance sheet. We do look at the strength of working capital is a really big item. We're not going to talk too much about working capital today, but I found in life there's a couple of things that you can really count on. You can count on death, taxes. My wife rules the roost at home, and you're going to argue about working capital. In almost 100% of transactions, there is some disagreement on working capital. What does that mean? Inherent in the valuation, and Al does this a lot in his formal valuations, is building an element of expected working capital. What is industry standard? What do we expect that to be delivered? I always describe it as when you go buy a new car and you show up at the dealership, you expect there to be gas in the tank. Right? If you don't have gas in the tank, you're going to be disappointed. So working capital, same thing. You have to deliver that. It's part of the value of the business. It's inherent in the multiple. Many times when I represent sellers, they always assume they get to keep working capital. Hey, I earned those receivables. I'm the one that sold the product. I get to keep that, and that's really not the case. So, but therein lies the diligence. Is if you're relying on that working capital as a basis for evaluation, how strong is that balance sheet, or how weak is it? What is the multiple? Understanding what the multiple should be is important. And the higher that multiple, the higher the risk of the transaction. How does that impact your financing? Which leads me to the next question: is can you afford a deal? Everyone gets excited about, hey, we got this opportunity, we're going to sign a deal, but how are you going to afford it? Where is the money coming from? Will the bank lend you the money? Will the seller hold paper? Do you have other sources of capital, either through your other operating businesses or other sources of capital? So once you understand that the multiple and what the valuation might be, then can you afford it? That's a key question. Significant risk and exposure. So Al talked a lot about that risk premium. And the higher the risk, typically the lower the valuation. So part of the diligence process is identifying those risks. We talked about customer concentration, key employees. Is the industry increasing or declining? What's the status of the industry? So we'll talk about more examples of things that we look for here in a little bit, but understanding those significant risks and exposures are part of that diligence process and will have a direct impact on valuation. What is the market opportunity? Obviously, this comes really into play for strategic buyers. What is the market opportunity for growth? What is the opportunity for synergies What types of synergies are there? Are there administrative cost savings? Can we merge HR departments? Can we merge IT departments and accounting? Those are all common questions. And we'll also get into an example of an expected synergy later on. Company expected certain synergies to take place, it didn't come to fruition, and it really caused that transaction to be a really bad deal for them. Other synergies could also be cross-selling. You have shared potentially now other customer bases that you can sell through. Many people think of synergies as cost savings, but there are business opportunity synergies that could take place that actually would enhance the value of the business. So transaction timelines, and why do I talk about this in regards to valuation and diligence? The reason I say that is many times we get involved in a transaction, we'll get a call from somebody or a call from an attorney, say, hey, our client signed a letter of intent. We need to get moving on this. We want to close in 30 days. And say there's no chance you're closing in 30 days. So there's usually, typical timelines, usually much longer than you might anticipate. And in today's environment with the potential for recession, I know seems like we've been talking about potential recession for almost over a year now, but a potential recession as well as rising interest rates, all of those really don't bode well for valuation. So many times in a transaction, especially if you're dealing with an investment banker, they always want to close as quick as possible. But you have to have a little bit more time to complete your diligence. And by the time you get to the end of that diligence timetable, the factors, the industry, the geographic, the macroeconomic trends, and interest rates may have changed since you started diligence, which could impact, again, your view on cash flow and how your financing with your bank's gonna close at the closing of the transaction. So the timeline could definitely have an impact. Now I want to talk about diligence and try to draw some connectivity to how that might impact not only valuation, but how might we be able to structure around those issues to keep the deal alive and or to sustain the value. Because the last thing you want to do if you're on the buy side is if there's a change in valuation, the seller's never going to like it. Even if you have rational reasons for why you're coming back to the table and saying, we need to reprice the deal from what we offered in our letter of intent, the seller never likes to see a decrease in purchase price. So if you come up with some creative ideas to restructure, we always try to do that. But with that said, some of the items, the major items that we look at is what I call find the magic. What is the magic? Magic is what makes the business worth something. This is particularly important for small to medium-sized family-run businesses. The magic is what makes it worth something. It could be key employees. It could be the owner who has key customer relationships. And so when the business sells, if that owner wants to spend more time in Florida or spend more time with grandkids, if that owner is not involved in those key customer relationships, is that magic lost? So the key is in diligence is identifying what that magic is. Could be trademark, could be a patent, could be all those things that we mentioned, making sure that those things are going to stay once we close the deal. So if it doesn't, business isn't worth as much. And then design your diligence to make sure that you understand the risks surrounding whatever that magic is. Strength of the management team. I know we talked about this. To the extent you have gaps to fill, you need to make sure that you can fill them and what that impact might be on earnings with increased payroll and benefits. The financing the transaction. Can we finance the deal? Depending on the sources of financing, could impact what you're willing to pay for that business. So if you have to, more leverage, the more risk you have. However, conversely, if you're taking on equity investors are going to expect a higher rate of return. So that all impacts value as well. Tax structure, sometimes I get, questions, from folks when we're talking about valuation, because, many times, again, we're talking in terms of EBITDA. And part of EBITDA, you add back taxes. So Mark, why does tax impact valuation? Well, at the end of the day, an important factor to consider as a buyer is cash flow. And so taxes are a big impact there. So there's a way that you can structure the transaction to have a better tax answer as a buyer. Now, many times what is good for a buyer is bad for the seller. If you can find a way to structure the deal properly to benefit both parties and give you a better tax answer, make that more tax efficient, that makes your cash flow better and would enhance the value of that target company. So we hear lots of things about asset and stock deals. But typically as a buyer, if you can structure it as an asset deal, you get a step up in basis in those assets, which then allows you to depreciate those for tax purposes and decrease your tax liability. That's a good answer. Conversely, in a stock deal, you generally don't get a step up in basis unless you make a special election, which the seller has to agree to. So typically stock deals are really not great for buyers and therefore really not great for cash flow. Again, depending on the circumstances. But we can pull some of these levers in structure. So then I'll probably try to touch on it a bit when we find issues. We can change the structure of the deal to potentially mitigate the risk and possibly give you also a better tax answer. So in terms of a couple of key items, additional key items, we do take a look at reserves. We talked about working capital and the quality of the balance sheet. Are there any unrecorded reserves, uncollectible receivables, slow-moving inventory? We talk, commitments and contingencies. Those are somewhat reserves. Are there pending lawsuits? And a lot of people say, well, yeah, we can just structure around it. You can change it from a stock deal to an asset deal. Only buy the assets and leave the lawsuit behind. But if the lawsuit is with a key customer, you can't structure around it. If it's with a key customer, you're going to lose that customer because of the lawsuit. That'll definitely have an impact. So it's key to understand that. And then, of course, environmental. We'll talk about a case study about environmental because we just came across one recently, though, that could have a detrimental impact on valuation. So commonly overlooked areas in diligence. I got to say that probably sales tax is, I'm almost ready to say, by far the biggest commonly overlooked area, but certainly very an area that people just don't pay attention to for some reason. And what is sales tax? Sales tax, we all know that Congress recently passed in recent years the Wayfair legislation that really increased the number of instances in which sales tax is now due when you're doing business in different states. So we commonly find that businesses don't pay attention to this, especially small and medium-sized family-owned businesses. And so in diligence, we look for, are they collecting or remitting the appropriate tax in the appropriate jurisdictions in which they're doing business? If they're not, we want to know about that. If you don't find that in diligence and find about it after the fact, you're going to owe that money. You're not going to be able to go back to the customer and say, oh, by the way, we forgot to collect and remit tax from you. The customer's going to say, no, that's your problem. So there's going to be a huge unrecorded liability that we're going to somehow try to satisfy. Key customers, I think we spend a decent amount of time there. Key people. One that's a thing I wanted to mention here in commonly overlooked areas, IT. So we did a seminar, I think about a month ago, that was almost wholly focused on IT and cybersecurity in acquisitions and what a risk that posed and some of the commitments and contingency that could create, as well as reputational risk. So if you've had a cybersecurity breach that has now impacted your brand and or customer loyalty, that could definitely increase earnings in the future and impact valuation.
And anybody can go back and check out our YouTube page and find that presentation if you want more information on that.
Mark, would you say that these are commonly overlooked because people are just unaware of them, or because they are choosing to ignore them to get a deal done?
Yeah, I'd say probably it's a common issue. That's a great question. I think the sales tax tends to be just in general sort of what we call hidden tax. If you're not collecting remaining tax, if you're not filing tax returns, and you don't ask the question, are you filing in the right jurisdictions, then the topic will never come up. So it's kind of like a hidden tax. And so it's probably a little bit lack of knowledge. And I think that all too often when diligence commences, companies may call in the CFO and others into that due diligence process, they may or may not have a tax background. And so sometimes they just kind of gloss over sales tax. Many times they forget to include the IT team. They don't have more of a holistic due diligence team. So that's just sometimes just a miss.
Good reason to have our salt guys involved in
Yeah.
these transactions.
Well, I keep, when we have a transaction, we have a salt team, I keep them very busy on those transactions. So quality of earnings, this is a real life example. I, of course, redacted names and places so that keep this confidential, but this is actually a real life quality of earnings analysis that we did for one of our clients. And so the purpose of this is to evaluate the earnings over a several year period and how consistent and reliable are they. So I want to point out a couple of things. First, right at the top, you see EBITDA as reported. The danger that we talked about, the rule of thumb, is that if you just take it at its surface, EBITDA as reported in the financial statements, and apply a multiple to that, you may arrive at a certain valuation if you use that rule of thumb. And I'll illustrate a little bit further here. So if you take EBITDA as reported for fiscal year 21 and say it was about roughly $3 million. But on an adjusted basis, if we look at non-recurring items and owner expenses and all these adjustments that you see down below that, we arrive at what we call EBITDA as adjusted. That's really the normalized EBITDA or recurring EBITDA after we take out all those non-recurring items. And there's a difference or a gap of roughly 230,000. Well, utilizing a multiple times 5 results in a $1.2 million difference in valuation. Not a lot of our clients, that's pretty significant. So the quality of earnings process identifies these adjustments and takes that, and then you can apply, maybe be more comfortable applying rule of thumb to say, now we know the economic realities as Alec raised it, to apply that multiple to. I want to point out a few other things as I look at this and say, okay, through my lens, how do I assess quality of earnings? If you look at EBITDA as reported, the buyer might say, well, look at how much our EBITDA has increased just under $1 million to almost $3 million. It's almost triple. Look how profitable we've come. But on an adjusted basis, if you go way down below, it increased from 1.5 to 2.7. Obviously, very good growth, very positive growth, but it certainly didn't triple. So it gives you a little bit of a different perspective on the quality of those earnings and what really has happened historically in the last couple of years. And just a couple of other items to note. Management had reported certain adjustments to us, saying, hey, we want to adjust our financial statements for non-recurring items. Common things that we've seen recently, obviously PPP loan forgiveness, that's not recurring income, so we deduct that out. And then you'll see many times very common other non-recurring expenses like transaction related fees. So that was fees in this particular example in line H of this analysis, where they were hiring professionals to help them with the transaction. So obviously that's non-recurring, and we add that back as a non-recurring expense. And everything in between B through G, and we're always looking for something similar, is owner-related expenses. As we know, personal businesses, they run different types of expenses through country clubs, owner compensation, things like that that are non-recurring. Those are all adjustments. And then through our analysis, we identify additional adjustments that come to an EBITDA as adjusted. So that's a very important analysis to perform as part of diligence. And this will help you give a better perspective on the economic realities of that business.
How many years do you typically like to look at when you do your due diligence?
Yeah, usually at least 3 years. We're finding now that we've just finished 22. You know, if you use a the rule of thumb, pun intended, of 3 years, you go back to really 2020. But I think what a lot of our clients are asking us to do, which makes common sense, add 1 more year to that because they want to look at pre-pandemic. Because there's some impact on what they call the pandemic bump. If you looked at a car dealership, you'd almost invariably see 2020 record years, right? Well, that's because of COVID. That's not really normal earnings. So we're usually saying right now, we're going back to usually 4 years now this time. I'd say after the pandemic kind of gets out of the picture, hopefully we'll get back to, sort of a normal look at things, a 3-year look back. So great question though. So I want to talk about some case examples. So deal's gone south. So this, particularly the first couple bullets, and I can emphasize not enough, and we talked about this earlier in Al's comments, go on site. In today's digital age, all too often I hear, oh, it's all in the data room. You can just do the work from your office. You don't need to come on site. And the more hesitancy that you have to going on site, the more that you may want to push to go on site and do a tour and just kind of observe things. Many times if my client is the buyer and they are not allowed to go on site, sometimes I recommend they don't do the deal. Why? Because all too often I find some significant issue when I do just a walk around. And many times the tour is done by somebody who's maybe not directly involved in the process. So I ask them questions they don't even know. They're providing me with answers that they shouldn't even really be providing because it's detrimental to their cause. So a couple examples. The case of the undocumented workers. So we did this tour. It was a pretty large acquisition of one of our clients. And so went on site and doing the tour, I started noticing makeshift signs on cardboard in like marker or ink in Spanish all over the place, all over the plant. They had their standard like safety signs, decals and things like that, but these makeshift signs of, in Spanish, and some I could kind of make out. It's El Baño, it means with an arrow, it means bathroom or restrooms that way. And so I said, why are all these signs in Spanish? So when we went back to the conference room to talk about additional diligence items that we were requesting, I asked, hey, how do you document citizenship and verify citizenship? And I think you could have heard a pin drop in the room. Because what we later found out after we knew that it was an issue, and I knew it was going to be an issue, we found out that out of 100 employees, 20 of their employees were undocumented. And this business did work with the White House. It was just unbelievable that somehow this slipped through the cracks. But our client, so the seller said, oh, we'll restructure the deal, we'll do an asset deal, we'll do different things to try to, we'll put in monies in escrow. So if you're caught, monies will be set aside for you to cover that risk. Well, my client didn't want anything to do with it. Undocumented workers, dealing with the White House was just not a situation that they really want to touch. So that deal went south. So the case of environmentally unfriendly. So this is actually a very recent case example. Again, we were the seller really is like, oh, we don't want you to come on site, it'll be disruptive. People will want to know what's going on. But we pushed and we went on site and we found that there were underground fuel storage tanks as well as a paint booth. And of course, we asked about their environmental compliance and if they had any phase 1 studies. Come to find out that they really weren't taking care of those types of things. And so that deal is currently on hold because they need to do environmental studies. And the deal may never close because they found some issues as they dug a little bit deeper into the situation. So I want to talk, actually, I'll try to get to a couple of cases because these are interesting, and then I'll try to open up with questions. So a GSA contract, this was actually very recent too, within the last couple of months. And one of my clients was buying a company, and we found out that they were a GSA contractor. What is GSA? For those that don't know, it's General Services Administration. And that is an arm of the government that actually pre-qualifies vendors for governmental agencies to perform services, to do. We found out that this particular company was a GSA contract. You might say, oh, that's a good thing, right? It's government, you get recurring work. But they were a small business set aside. And what happens is in a GSA contract, if you're a small business set aside, you're bought by a larger conglomerate, you then get categorized as a large company now. And so we said, what's going to happen with that small business set aside? Well, they would lose that status. Their biggest customer, the reason they were doing business with them is because governmental agency required them to subcontract to a small business set aside GSA contractor. And they said, we probably won't do business with them. And so that was 30% of the revenue, 40% of the EBITDA. And so our client says, we got to retrade the deal. It saved our client about $2 million of purchase price. Just a one simple question.
Yeah,
So I
just blindly applying a rule of thumb to that EBITDA, not thinking about that.
Yeah.
You're overvaluing your business, overvaluing the prospect you're trying to buy.
Yeah, that's one, and I think I do have time for one more case example that's not here on the page here. So we actually helped another client. This is an example of making sure there's a strategic fit and that the company that you're buying fits your strategy. So one of our clients was looking at buying a machine shop. They were outsourcing a lot of the machining, a lot of the parts, and they thought the strategy was let's buy a machine shop so that we can sort of capture that margin internally, because the machine shop would mark up that service to my client, and so therefore we could sort of capture that cost savings internally. And so I looked at several machine shops and said, this is the right fit. We did our financial diligence, but no one did really much operational diligence. They closed the deal, and several weeks later, after the operations team got involved in integrating and finding out, hey, they're going to do some of our machining now, they quickly figured out that they didn't have the right equipment to actually do the machining that they needed. So the entire reason they did the entire transaction just flew out the window. Was it a good business? Yeah, it was profitable, but they paid way too much because they had anticipated a profit or synergy. Paid way too much for that machine shop. So those are examples I have, and I think it looks like we might have a question.
Yeah, we do. So I'm going to give the guys a minute to just look over the questions that were submitted. If you do have one, you can just put it in the question section of the toolbar and we'll get it answered for you today. Also too, just a quick reminder, there will be a post webinar survey coming out to you. That's another great way to do some follow-up with our experts today, set up a meeting with them. You can put additional questions in there. But Al and Mark, do you want to take this question? I think there's a couple questions in there.
Yep. So the question is, when valuing a purchase of an interest, as opposed to the entire company, so something less than 50%, less than a controlling interest, do I apply a discount to the overall value I develop? And if so, what are my best practices for determining a discount? So it depends on the purpose of the valuation, the premise of value. Generally, if I'm doing a gift or estate tax valuation, I'll generally apply a discount, especially if it's a minority interest, because the tax code supports that. You would apply a discount for lack of control, and you would apply a discount for lack of marketability. Discount for lack of control, meaning that I don't have control over certain aspects of the business, such as owner's compensation, benefits the owners, accruing direction, but there's other things like that that I just can't control, basis, being a minority interest holder. And then you'd also apply discount for lack of marketability, meaning that my interest is less liquid than an interest in a publicly traded stock, because there's a market for publicly traded stock versus it's very difficult to sell a share of a privately held business in the marketplace in comparison. Generally, the discounts for lack of marketability range from 25% to 40%. Discounts for lack of control, there's databases out there that'll give you a good percent. I don't really like to use a discount for lack of control using a subjective percentage. What I like to do is just not impact the cash flows. So Mark kind of showed you like the adjustments to EBITDA that he made in his due diligence process. If I'm doing a minority interest holding and valuing, maybe I won't make those owners comp adjustments. Maybe I won't make those adjustments to rent if you're paying rent to a related party owned business that holds it's a holding company for that building, and kind of integrate that discount for lack of control in that value, because as Mark pointed out, if my EBITDA is lower, I get a lower value for my business. So if I have less cash flow available to me as a minority shareholder, my value is lower. So I kind of build in my discount for lack of control through those cash flows directly.
Yeah, I think just to add a little color to that, so I think the bottom line on that question too, or another comment there is that that particular element of valuation is highly subjective.
Yeah.
And has a lot of complications to it depending on facts and circumstances, family-owned business, non-family-owned business, lots of different situations. So, a participant, if you want to have a broader conversation, that would kind of give you some of the ins and outs and some of the other considerations that you can think about in value. If you're involved in a situation where there is your lack of marketability or some kind of minority interest that you're looking to buy.
Great, thanks, guys. We're right at 1 o'clock, so I am gonna end it there. If you did submit a question and we didn't get to it today, we will do a follow-up email with you to answer that for you. Also, just want a reminder, our next in-person event is May 23rd, continuing with this topic, mergers, best practices for finance, tax, and from a tax, finance, people, and process perspective. So just wanted to let you know that. Also, our next webinar will be June 6th. We'll be discussing introduction to cost segregations and related tax benefits.
Yeah, and those, I'll just jump in, Carolyn, on that live seminar, the benefit, if you're interested in hearing more of a sort of a holistic approach on diligence, right? Because it's not, we talk a lot about finance and tax.
Mhm.
We're gonna have some of our co-speakers from Employer Services Corporation and Meliora Group, an operating black belt specialist. They're also gonna talk about HR elements as well as operational synergies. So those that are interested in those topics, be a great time to attend.
Yeah, it'd be nicely well-rounded. So hopefully we'll see you May 23rd and again on June 6th for our next webinar. Have a great day, everyone. Thank you.